Je vous souhaite la bienvenue pour cette première réunion du club du CEPII 2022. Et je suis très heureux que cette première réunion soit avec une personnalité aussi majeure de l'économie internationale. Avant d'introduire la réunion en anglais, je vais vous dire deux mots sur, d'une part, le club du CEPII pour celles et ceux qui ne le connaissent pas, et d'autre part, sur les questions après la présentation de l'intervenant. Le club du CEPII, c'est une association loi 1901 qui est bien sûr très liée au CEPII, mais qui ne vit que des adhésions. Et donc, cette réunion est largement ouverte, mais je vous invite à considérer une adhésion au club. Ensuite, en ce qui concerne les questions, je vous inviterai à les poser le plus tôt possible, y compris pendant l'intervention, par le chat, puisque nous sommes très nombreux. J'essaierai de regrouper les questions par thème, et donc si vous pouvez, lorsque vous posez une question, commencer par le thème de votre question, c'est plus facile pour moi de les lire et de les synthétiser tout en animant la réunion. So now I will switch to English. The world of money and finance brought us to the brink in 2008 and 2009, mainly because of the financial innovations of the previous 2 decades that had been poorly understood and insufficiently regulated. In the aftermath of the consequences of this major financial crisis, the attention focused on the consequences of the crisis, perhaps at the expense of a new and more radical wave of innovation that was emerging precisely at the same time. One lesson is that when faced with innovations or disruptions, the ability to understand and to anticipate is key. However, the disorderly rise over the last 10 years of private digital currencies and of alternative forms of financial intermediation is particularly difficult to grasp, to place within a global vision of monetary and financial phenomena, in a word, to better understand. All the more since the problem itself is constantly changing thanks to an unprecedented pace of innovation. The reaction of the authorities is still in its infancy and itself complex to grasp for outsiders. The latter are often assailed by fragmented information to which it is difficult to make sense. We can only be delighted that a specialist, but also a pedagogue of monetary issues, and especially of international monetary issues, has taken on this titanic task in such an anxiety-provoking environment. It is also very useful that this specialist is not content to observe the issue from a Western point of view, but is a very fine connoisseur of financial and monetary issues in emerging countries, and especially in China. We are extremely pleased to welcome Eswar Prasad for the presentation of his new book, The Future of Money, How the Digital Revolution is Transforming Currencies and Finance. For those of you who don't know his work yet, I may just mention the title of his 2 previous books, Gaining Currency, The Rise of the Renminbi in 2016, and The Dollar Trap, How the Dollar Tightened its Grip on Global Finance, 2014. Eswar followed a classic path of the Indian-born American intellectual elite. He began his studies in economics at the University of Madras, moved to the US, where he received his master from Brown University and his PhD from the University of Chicago. Eswar is now the Tolani Senior Professor of Trade Policy and Professor of Economics at Cornell University. He is also a Senior Fellow at the Brookings Institution and a Research Associate at the National Bureau of Economic Research and ISA, a German research institution. Eswar is also the former head of the IMF Financial Studies and China divisions. I may add that in addition to his many academic achievements and public service achievements, Eswar is a frequent speaker before the US Congress, where he is called to testify on international economic issues. Eswar, the floor is yours.
Thank you very much, Christophe, for that very kind introduction. If only I could have been in Paris in person to deliver this lecture, and if only my French was good enough to be able to deliver this lecture in French. But unfortunately, after 2 or 3 years of studying French, the passé simple and the passé conditionnel broke my spirit. So my French today is not good enough to be able to speak to you in that lovely language. This book had a long journey and actually arose from my desire to get a better understanding of changes taking place in international finance more broadly, but also in domestic finance. And I was most interested in how digital currencies might affect some issues related to central banking. But as I started looking into the issues, I realized that I would not be able to look at these issues about digital currencies in isolation, but would have to think about the broader context in which these changes were taking place. And there is, of course, the fintech revolution that has been going on. And fintech, of course, is a broad term that one can think about as encapsulating the many financial innovations that are taking place around the world. But I think it's a good place to start. And then, of course, there is the issue of cryptocurrencies, which came onto the stage right after the global financial crisis, as Christophe alluded to. And then I think there is an important jumping off point to official currencies beginning to compete with these private currencies. And all of these issues have implications beyond their narrow spheres. They do have implications for the structure of financial markets and institutions, and indeed for many aspects of monetary policy and financial regulation, and ultimately for the international monetary system. So this is why what was meant to be a relatively slim and modest volume about digital currencies turned into a 500-page tome. But I think it's important to keep the relationship among these different elements in mind. So let's start by thinking about fintech. Now, financial innovation, of course, is nothing particularly new. We've had financial innovation even since the creation of money, which was a remarkable innovation in itself. And then one can think about the emergence of paper currency in China in the 7th century as being another very important innovation. So the question is, what is different now? What we're seeing, of course, is a raft of new fintech players that are emerging in different aspects of financial intermediation, ranging from internet banks of various sorts to more direct platforms that allow for financial intermediation between savers and borrowers without having the traditional financial intermediaries in the middle of these interactions. Another interesting feature is that in emerging market economies in particular, fintech platforms have gained even more significant traction, perhaps because there is a much greater need in these economies. There are some common characteristics to this wave of fintech. A lot of it is reliant on digital platforms, which means that most of it is automated. You have much greater efficiency, the ability to scale up in a way that one can handle even small scale transactions such as micro loans in a very effective way. And all of this is certainly going to provide a lot of benefits. Now, as we think about the advantages, there are many at hand. China's My Bank, which is part of the Ant Group, has this remarkable innovation of what it calls the 3-1-0 model of providing loans, where basically you can fill up a loan or credit application even on your mobile phone in under 3 minutes. You get your loan approved in less than 1 minute with zero human intervention. It turns out that many of these platforms are also built on the ability to use information from a variety of other transactions on related platforms in order to come up with better credit scoring systems, which generally results in lower default rates, although this is by no means a uniform issue. There are many concerns about some of these developments as well. While some of these fintech platforms in China have proved to be very efficient and have relatively low default rates, there are others in many developing countries around the world where they are meeting a real need. For a poor household or an entrepreneur wanting to start a business in a developing country, if the choice is between having no credit at all from the formal financial system and getting credit with a relatively high interest rate from a non-traditional financial services provider, that choice is clear. But it does mean that there are many risks related to these high interest rates, questions about the ability to repay those loans. And of course, anytime you start thinking about digital platforms, there are issues related to privacy considerations and a variety of other unknown risks. Now, there are many other aspects in which fintech is making inroads, from insurance to wealth management, but most prominently in the area of retail payments. And here, of course, the Chinese payment providers, Alipay and WeChat Pay, have led the way. But around the world, we see retail payments becoming a lot more efficient. And that is good for consumers and businesses. And I think it sets an important building block for the shift away from cash or physical currency, which is one of the key themes of my book. The fact that we are at the beginning of something important transforming in international finance. The other aspect in which payments have become much more efficient, of course, is in the context of international payments. International payments have been beset by a variety of efficiencies related to the cost of those payments, the speed with which they are executed, which tends to be very slow, the inability to track them in real time. And we're already beginning to see very significant changes taking place because technology is opening up new possibilities. Now, at this stage, it's worth pausing and thinking about what it is of all that I have told you that makes this wave of financial innovation particularly interesting or special relative to earlier waves of financial innovation. As I've already illustrated, I think one very important difference is that these innovations are being built on digital platforms. Now, some of the innovations I've spoken about are really just better ways of doing existing business, but we are also beginning to see the ability to use these digital platforms in a way that bypasses traditional markets and institutions. And that, I think, is going to have fairly significant effects. And of course, one of the aspects that we are seeing is a very dramatic increase in these fintech innovations in emerging market economies and developing economies more broadly. So we're beginning to see this create space for foundational innovations in finance, partly because the digital transformation makes it much easier for new entrants into this space, and also does not provide have any constraints related to physical infrastructure. We're also seeing leapfrogging by emerging markets. And that's with some good reasons, including the fact that you have fewer existing large players who can block innovation, a huge latent demand from a rising middle class, and regulators who are willing to provide a lot more room for these innovations to take place. But there are challenges aplenty coming for the existing financial institutions, especially commercial banks, but also for government regulators, because as we shift towards non-traditional forms of finance, there are going to be a lot of issues related to monetary policy as well as financial stability. But I think we are at the threshold, and in fact, we may already be in the midst of some fairly dramatic changes. Now, as we move from fintech to thinking about the world of cryptocurrencies, of course, that is where the even more dramatic transformations have been created by technologies. So as we reflect on fintech, it's worth thinking about the fact that there are many benefits in terms of efficiency gains, more efficiency in terms of direct financial intermediation, much greater possibilities for including even low-income households in the financial system, and a lot of disruption, which can be good, but in some ways may not be as good, especially if financial markets and regulators are not well prepared for that. And it's worth thinking about the fact that even while technology can create a lot of benefits, it could come back to haunt us by creating even more concentration and market power, which we're already seeing in many dimensions of commerce and even finance. Now, in the midst of all of this, we, of course, have seen a very difficult period of about a decade and a half. And one of the darkest moments in global finance, of course, was in September 15, 2008, the day of the Lehman moment, when Lehman Brothers, the storied US financial firm, went under and looked like it might take down the US financial system and indeed the global financial system with it. Now, in finance, as with anything else, timing is everything. And the appearance of Bitcoin on the world stage was impeccably timed. The original white paper that introduced Bitcoin to the world with a fairly modest sounding set of objectives appeared on a cryptography mailing site just 6 weeks after the Lehman moment. And it was quite a remarkable paper. In fact, the 10-page white paper, which lays out the concept of Bitcoin, is a marvel in terms of how, in a very spare amount of space, whoever it was that created Bitcoin lays out not just the structure of Bitcoin, but also a manifesto that suggests something that was very much within the zeitgeist of the time, this libertarian approach of trying to think about getting around traditional forms of financial intermediation. And what Bitcoin promised to do was to provide a system for conducting transactions in a digital form without relying on trusted third parties or intermediaries. That trust could come from either central bank money or intermediaries such as commercial banks or other payment providers. And the notion was that one could do this in a pseudonymous way, that is, using only digital identities. If you think about the technical challenges that all of this means, these are quite enormous and might seem almost insurmountable. How on earth can one validate transactions without a trusted third party, achieve consensus about the validity of transactions without a trusted authority, be able to verify those transactions, make sure that those transaction records cannot be changed, that is, that they are immutable and so on. So these sound like phenomenal challenges. Now, it turns out that Bitcoin found a very elegant way to solve some of these issues. One of the key questions, of course, is how one can undertake validation of transactions without relying on a trusted third party. In 1999, actually a decade before Bitcoin came on the world stage, my Cornell colleague, Ari Juels, actually came up with this notion of proof of work. It was essentially a way of trying to think about how you can create security in public ledger systems. And essentially what the Bitcoin approach to this consensus proof protocol does is to create a randomly generated numerical problem which can only be solved by brute force computing power. So very cool analytical methods and so on cannot be used to solve it. Essentially, the only way to solve these problems is by guessing solutions. So of course, the more computing power that you can devote to guessing potential solutions, the faster you're going to be able to solve it. But this uses a very clever approach through something called hash functions, which essentially means that once you know the solution, verifying that it is correct is in fact very easy to do. And it turns out that once whoever solves this numerical puzzle first can broadcast that solution, that essentially becomes the person or computer who has the privilege of validating that block of transactions. And each time a block of transactions is validated, it is then chained to the existing block of previous transactions using computer code. And this is where the term blockchain comes from. So one question is, why would anybody devote computing power to this? How can one ensure security of the system? So if you think about the way Bitcoin works, essentially you have people with their digital identities. And one can think about digital identities as having two aspects. One is what is called a public key, which is sort of like the account number to your bank. If I knew one of your bank account numbers, I could put money in it, but I could not take money out of it. For that, you would need additional information such as your password, which in the cryptography world, the equivalent is what is called the private key, which is known only to the owner of a particular digital wallet or digital account. So one can use just the public key or these digital identities to broadcast transactions on the internet. These transactions are collected together into blocks. These are verified by people who solve these numerical problems. They're called miners. And then you have these blocks of transactions, which are then chained to previous transactions. And then what I view as one of the interesting innovations through which Bitcoin adapts distributed ledger technology, which is essentially by posting these digital ledgers or blockchains on the web on multiple computers. Now, this is an interesting element of the security and resiliency of the Bitcoin network, because all of the transactions undertaken using Bitcoin are posted on the web for everybody to see. And these multiple nodes of the network, that is multiple computers, are synchronized in real time. It makes it very difficult, in fact, to tamper with any particular transaction, particularly once it enters a historical record. So what Bitcoin has accomplished is something truly marvelous, but it turns out that it doesn't work that well in certain respects. In particular, what it was supposed to provide was a medium of exchange, and it does not work very well as a medium of exchange. One reason, of course, it has very unstable value, and it's very difficult to have an effective medium of exchange that does not have stable value relative to the unit of account, which is usually the domestic fiat currency. It also turns out that the Bitcoin network cannot directly handle a large volume of transactions, and the processing times are very slow. Each block of transactions, which typically has about 2,000 transactions, is added to the blockchain only once every 10 minutes or so. So this means that the network can directly process only about 5 to 6 transactions per second, which is a minuscule amount. There are other problems, of course, with Bitcoin. In the early days, there were concerns that it was being largely used to fuel illicit activities. If you lose your digital key, that is your account number, if it was an account number or password of a bank, you can walk into your bank branch or give them a call and get your account password reset. But if you lose your private digital key, it's gone, because there is no authority that you can turn to get that information back. So in all of this, what is remarkable is that Bitcoin, which was supposed to be a medium of exchange, has instead become a speculative financial asset. Now, why does it have any value at all if it doesn't have any intrinsic purpose? Bitcoin devotees will tell you that relative to a fiat currency, such as the dollar or the euro, that can be printed at will by a central bank, it turns out that Bitcoin has an element of scarcity. There can be at most 21 million Bitcoins ever created. About 19 million Bitcoins have been created so far. But to an economist, that's still a dubious proposition. Just because something is scarce, it's not obvious that it should have value. So I remain a bit of a skeptic about Bitcoin, especially as a store of value. Another problem is that this consensus protocol that Bitcoin very cleverly uses, it is very destructive to the environment because you require huge amounts of computing power. This computing is done not through a standard laptop, but through these very specialized devices called ASICs. So it creates a lot of computer detritus. And what I'm showing you here is a picture of a Bitcoin mining farm, essentially huge stacks of computers devoted to the sole purpose of solving these numerical problems, which really have no benefit to humanity. So Bitcoin started a revolution, but I think it has gone a bit astray. Now, there are many weaknesses of Bitcoin that new cryptocurrencies have come up to try to fix. One of the more interesting types of cryptocurrencies are called stable coins, which essentially are coins whose stable value comes from the fact that they are backed up by stores of fiat currencies. And stable coins essentially are supposed to be more effective payment mechanisms. But of course, there is a delicious irony here. The whole point of cryptocurrencies was to get away from government or central bank issued money. And stable coins, ironically, get their stable value precisely because they're backed up by stores of fiat currencies. There are new consensus protocols that are coming up that are far more efficient than proof of work. And there are new cryptocurrencies that are coming up that turn out to have much stronger anonymity than Bitcoin, which it turns out is not as anonymous as we might have thought. And of course, a great deal of attention has been paid to Facebook's proposal through an association that it set up called the DM Association to issue its own stable coins. And of course, there is a range of meme coins that you've no doubt heard about, including Dogecoin, which seem to be even more speculative than Bitcoin because they don't even pretend to have a typical use. Now, stable coins have begun to gain some traction because they provide a variety of services that I think are useful. They do provide the prospect for greater financial inclusion, faster and more efficient payments, both within and across national borders. But there are concerns as well about whether these could become conduits for shadow flows of money, and whether the lack of regulatory oversight could lead to these cryptocurrencies themselves becoming financial stability risks. Now, while stable coins have been developing, and these are interesting issues related to cryptocurrencies themselves, there is an underlying movement set off by Bitcoin that I think has far more interesting potential. I did express a great deal of skepticism of Bitcoin as a store of value, but I think the blockchain technology created by Bitcoin is going to be its real legacy. Blockchains provide a lot of opportunities for conducting a variety of transactions in a much more efficient way. And this entire movement, where essentially you don't rely on a trusted third party, such as a government agency or a commercial bank or traditional financial institution to conduct transactions, is coming to be known as DeFi or decentralized finance. This is built largely on these decentralized blockchains. And the key aspect is that one can conduct a broad range of commercial as well as financial transactions without using a financial intermediary. Blockchain technology in the form of decentralized finance now also has a variety of other opportunities that it is providing, including what are called smart contracts, which are essentially self-executing computer programs that allow transactions to take place without a third party being involved. The remarkable thing is that while all of this might sound futuristic, the future is already here. Let's first take a step back and think about what decentralization means. Now, there are some key features of decentralized blockchains, and I'm borrowing here from Vitalik Buterin, who's the creator of the second largest cryptocurrency in the world, Ethereum, and who's responsible for a lot of the thinking in this space. He talks about decentralized blockchains having decentralized architectures, that is, distributed ledgers are maintained on multiple nodes, so there isn't a single point of failure. Decentralized governance implies that you don't have control of the system by one centralized authority, such as a government agency or a financial institution. The community governs itself, and then you have decentralized trust, where trust is attained through a public consensus mechanism. So you can see from my description of Bitcoin that it is, in effect, the earliest manifestation of decentralized finance. But it's worth keeping in mind that the entire system is logically decentralized because the digital ledgers that I spoke about are synchronized in real time across multiple nodes of the network. So this provides the possibility for computer code to conduct certain transactions that in the past and even now we rely on traditional financial intermediaries for. So here is an example of a simple smart contract. And I can tell you this is one of the very simplest versions. There are far more sophisticated smart contracts with much greater functionality that are already operating right now and conducting real transactions. So in this transaction, one can think about a financial asset being exchanged for money in digital form, of course, or where financial assets are being swapped. Now, one key element of conducting these transactions on the blockchain is that financial assets, money, and so on need to be available in tokenized form. And of course, one can essentially think about a distributed ledger as an ownership registry where various assets, ownership records are maintained in digital form. So what does a smart contract do? Let's say there are two people who want to exchange financial assets, one for the other. Usually you might go into an attorney's office. If you wanted to buy a house, you might go into a real estate settlement attorney, which at least is what you would do in the US. And then the attorney would make sure that the title for the house is being transferred at the same time that the money from the purchaser is being given to the seller. It turns out a smart contract can do all of this to computer code. Once two people agree on the details of a transaction, that smart contract is then posted on the web, which makes it very difficult to tamper with. And then the smart contract itself turns out to be the escrow. So when the two parties deposit the tokenized forms of their financial assets, which again could be assets or money, into the smart contract then makes sure that the conditions are fulfilled and then swaps the ownership of that contract. There is one very important feature of smart contracts and other aspects of decentralized finance that becomes crucial here, which is that of atomicity. Atomicity essentially means that all the aspects of a transaction, all the elements have to be fulfilled at the same time or the transaction does not take place. So in other words, if one person provides a financial asset as promised to the escrow, but the other person does not, then the contract just falls apart and the initial owner of the asset that was escrowed gets his or her money or asset back. Again, one might wonder how on earth this can work without being tampered with, but it turns out it does work. So it is sort of remarkable that we are now in a situation where one can actually undertake these transactions quite effectively. And it has a variety of advantages. The fact that you don't have a single point of failure, such as the computers of one institution, makes these things more secure, as it turns out. It makes it harder to attack these systems, and it becomes harder for a few participants in the system to collude in a way that is detrimental to the overall financial ecosystem. In addition, there are many important features of a decentralized system. It is permissionless, censorship resistant, and open. And this is where the promise of decentralized finance becomes very important, that you don't need necessarily a bank account or see or bona fides being verified by a finance institution to be able to participate in decentralized finance, which of course creates certain risks as well. But it turns out there are even more interesting innovations that are now taking place through this feature of decentralized finance called permissionless composability. Because you have a lot of these financial products and services essentially as being sort of like computer modules that are, or software modules that are based on open source code, developers can combine different modules in order to create new financial products and services. So for instance, there is a savings game that has been created in some corners of decentralized finance, where people who own some amount of cryptocurrency can put that into a loan contract, which can then be borrowed by other people. You can withdraw stable coins, put that into what is effectively an interest-bearing account, but instead of everybody who puts money into that interest-bearing account getting a return, there is one lucky winner who gets the entire interest or return on that pool of savings. And then all the other people who participate in that game just get their capital back. Again, these products already exist out there. Now, there are, of course, a lot of concerns about whether these are legitimate products, what sort of risks they may pose. DeFi adherence will tell you that you can even plug in regulatory and compliance tools that can take care of these risks. But there are a variety of risks. I had an op-ed in the Financial Times a couple of months ago laying out these risks, and it got a fairly harsh set of reactions from the DeFi community. But as I pointed out, there are lots of risks that DeFi can mitigate, including default and liquidity risk, because many of these contracts can in fact be accomplished in literally the flash of an eye. So many of the traditional sources of risk are eliminated, but you still do have technological vulnerabilities, the fact that you have risks related to these smart contracts, the fact that decentralized governance creates certain issues of its own. And of course, these blockchains are closed financial ecosystems, but they need to communicate with the real world in order to get price data or other forms of communication. And this is conducted through what are called price oracles or other forms of more general oracles, which have a lot of vulnerabilities as well. So one important theme that I emphasize in the book is that while technology, especially financial technology of the sort that I've described, is remarkably innovative and creates a lot of new opportunities for bringing more people into the financial system, for creating new products and services that can be provided, even to low-income households, even on a broad scale in low-income economies, we should not rely on technology to fix all problems or to eliminate all risks altogether. So there are going to be a variety of risks that these create for monetary policy in particular. So if one thinks about traditional financial institutions, especially commercial banks, taking a hit to their business model from many of these innovations that I've mentioned, that becomes an issue for central banks. You know, the way in which central banks' actions, that is changes in policy, interest rates, and other forms of central bank operations, how they get translated into economic activity and inflation is already not very well understood. One aspect we do understand is how monetary policy operates to the banking channel. Now, if traditional commercial banks become less important in domestic finance, it's going to make monetary policy implementation as well as transmission much more challenging. There are also concerns about financial stability from these new products and services. For emerging markets, there are concerns also about stability of the external sector if you have new ways of moving money across borders. But even at the level of households, I think there are real concerns about whether we might have adequate investor protection, especially since nobody controls access to decentralized finance through a gateway such as a commercial bank. So there are many, many challenges coming up. Now, central banks around the world have not been sitting idle as these challenges come forth. On the one side, they are certainly taking account of how these changes might change financial markets and institutions and what the implications might be for monetary policy and financial stability. But they're also recognizing that there are challenges that these new innovations pose to one key aspect of central banking, which is the creation of retail money. Now, of course, central banks create money largely in digital form, but in most economies, the physical currency that they provide still keeps central bank money relevant at the retail level. And here there are some challenges that are coming up, but also some potential opportunities that I think central banks are recognizing. So there are a number of central banks around the world that have begun to experiment with or are contemplating experimenting with CBDC. One question is why? Yes, the disappearance of physical cash, if we have digital payments beginning to become more prevalent, might be a concern. But why should central banks be so concerned about physical currency, which already doesn't play such a big role in our day-to-day financial transactions? Why should central banks be concerned? It turns out there are a variety of motivations for considering central bank digital currencies or CBDCs. Now, it's worth keeping in mind that CBDCs are just digital versions of the physical currency that central banks just provide, but these could provide greater financial inclusion in many developing economies and even in some advanced economies, including the US. A significant portion of the population is unbanked or underbanked. It turns out in the US, it's about 5% of households, which is not a huge but not trivial number either. One can think about a central bank digital currency, especially if it takes the form of each citizen in a country maintaining an account with the central bank, which is now technologically quite feasible. That could provide essentially easy access to a low-cost digital payment system, but potentially also portal for basic banking products and services. So you might think about a CBDC as essentially improving the options in terms of payment systems. Now, it turns out that there are countries like Sweden, for instance, where the private sector is doing a perfectly good job providing digital payments to consumers and businesses. But the Swedish central bank, the Riksbank, views the e-krona or digital krona project as essentially providing a backstop to a private payments infrastructure. That is to say, let the private sector provide payments, but the central bank in maintaining financial stability needs to make sure that if there are technological or confidence vulnerabilities in a private payments infrastructure, the central bank needs to provide at least a backstop. There are some central banks that also view providing physical currency or digital currency that is still used in retail transactions as an important element of monetary sovereignty. China is an interesting case. In China, these two payment providers that I alluded to earlier, Alipay and WeChat Pay, are doing a fantastic job of blanketing the country with retail payments that everybody has access to, even low-income consumers and businesses. So the use of cash in Beijing is in China is very limited. My last international trip before the pandemic started was to Beijing in December of 2019. And I literally felt like I was the only person in Beijing still using yuan banknotes to try to pay my cab driver or to buy a cup of coffee. Everybody else in China, it appears, uses their mobile phones to make payments. In China, the government seems to be concerned that these two payment providers are doing a fantastic job, but now have control of the entire payment systems. They've not been making it easy for new payment providers to enter the payment space. They control a massive amount of data, which they've not been willing to share with the government. So yes, you've no doubt already noticed the government has taken steps to cut down Ant Group, which is a conglomerate that runs Alipay, to a smaller size. So in each country, there seem to be different motivations at play, but there are many benefits that one can think about in the context of a CBDC. You can get much more efficiency in the conduct of retail payments using central banks' money, but a central bank digital currency account also opens up possibilities for monetary policy in very perilous times. We've seen in the Eurozone and many other parts of the world, central banks trying to impose negative policy rates, trying to think about undertaking helicopter drops of money, large transfers of money to households in order to protect them from economic distress, as was done in the US. All of this becomes a lot easier if you have central bank digital currency accounts. Now, these are certainly not tools that any central bank wants to use in a regular manner, but in the last 15 years, we've certainly lived through very perilous times, and it's not bad for central banks to have these tools at their disposal. But it also has some other advantages even in normal times. The CBDC would make it much harder to use central bank money for illicit transactions. It would bring a lot of economic activity out of the shadows and increase the tax base. But there are risks as well, that you could have a flight of deposits from commercial banks into central banks. You could block private sector innovation in payments, and there might be both technological vulnerabilities and vulnerabilities related to privacy considerations. So it appears that the way we are thinking about CBDCs, especially the form in which these experiments are going forward in China and Sweden, suggests that there might be some ways to mitigate, if not entirely eliminate, these risks. So in both of these countries, a dual layer approach is being adopted, much like cash is now distributed to commercial banks, which in turn distribute it to their clients, who could be businesses or households. What is happening is that we are setting up an architecture where the central bank provides a payment infrastructure at the back end, but the front end in terms of payments is still managed by commercial banks and other payment providers. So one can think about these non-interest bearing digital wallets, CBDC digital wallets, being maintained side by side with the interest bearing digital accounts. And most accounts are largely digital now of commercial banks. So effectively, the CBDC acts as a token that allows for interoperability. That is, it allows for migration across different payment platforms. So it allows for private payment providers to continue innovating in the provision of payment services using the central bank money. There are also new technologies that are arising that might provide at least some degree of transaction privacy in a limited form, maybe for small value transactions. Of course, no central bank wants to allow its money to be used for illicit purposes. So I think the reality is that central bank money and other digital forms of money are going to have traceability and auditability. Now, the CBDC revolution also is already here. There are two countries, the Bahamas, which launched the first nationwide CBDC, the sand dollar, in October 2020, and Nigeria, which have already gone forward. CBDC trials are underway in China, Sweden, and Japan, and in the Eurozone, plus many other economies. We already have background research being undertaken by central banks. The Federal Reserve has been somewhat slower to move on this, although the Fed will in any day now be releasing a policy paper, which may not take a stance on whether the Fed should issue a CBDC or not, but at least might give policymakers a sense of the possibilities. Now, it turns out that central banks also have wholesale money that they use for interbank payment and settlement, and there is some action there as well to use the new technologies, blockchain and otherwise, to create more efficiencies, both in terms of interbank payment and settlement, but also cross-border payment and settlement. And it turns out that these experiments are showing that there are some advantages, but a variety of challenges as well. So in the last portion of my lecture, let me talk about what all of this might mean for the international monetary system, and in particular, the configuration of currencies around the world. There are some important changes coming. Certainly, we're going to see reduced frictions in international payments, and that's going to be good in a variety of ways. It's going to make it much easier to conduct international trade. It's going to make it much easier for economic migrants to send remittances back to their home countries at a lower cost, more efficiently. It also means that households, even in emerging market economies, will have greater access to portfolio diversification opportunities around the world. Even small-scale entrepreneurs might one day have easy access to a global pool of capital, but it also means that we might have a lower need for vehicle currencies that are now used to intermediate transactions. Right now, the cost of trading in bilateral pairs of currencies that are relatively small, say between the Chinese yuan and the Russian ruble, or the Indian rupee and the Nigerian currency, for instance, those are very costly transactions. So it might be more effective if China was buying oil from Nigeria, for instance, to change the Nigerian naira into US dollars, and then do a corresponding transaction where one changes the US dollars into Indian rupees. As international payments become more effective, you might no longer need the dollar or the euro as a vehicle currency. So the relative importance of payments conducted in these currencies is going to change. But this is also going to create some challenges for emerging market economies in particular. There are many countries around the world which don't have credible currencies or credible central banks. One can very well see a digital version of the dollar or a digital version of the yuan potentially rivaling these currencies and even displacing them. And in fact, it might not even be an official currency, certainly a currency or a stable coin issued by, say, Facebook or Amazon, which have widespread reach around the world, which have large financial resources. Those might be seen as more trusted than some of these currencies. But it's also going to become much harder to manage capital flows and exchange rates for these economies as the conduits for international capital flows become much larger and expand in both size as well as volume. My view is that the configuration of reserve currencies is, however, not going to change. There's been a lot of speculation about whether easy access to a digital yuan, a digital version of the Chinese currency, might increase its standing as a global reserve currency that could one day rival the dollar. I don't think so. I can well see the Chinese yuan gaining more traction as an international payment currency. But for a reserve currency, what matters is no longer just digital, and it's no longer just the size of a country or the depth of its financial markets, but ultimately, in addition to deep and liquid financial markets, which China is beginning to have, you also need an institutional framework that is necessary to maintain the trust of foreign investors. This includes the rule of law, checks and balances that are institutionalized, and an independent central bank. So my view, at least, is that there isn't a huge change coming in the configuration of reserve currencies around the world. But certainly, we can see some significant changes coming up in the context of international payment currencies. So let me conclude this lecture by talking about the big picture issues that many of these changes come up with. And one key issue that I think every economy, every society is going to grapple with is exactly what the role of the government and central bank is going to be in all of this. If you have a CBDC, that could potentially displace private payment systems. It could hinder private sector innovation. So what role the government plays in ensuring financial stability and good regulation without stepping on the private sector's toes, I think is a really important issue, especially if we come up with innovations such as CBDCs that might end up threatening commercial banks and other financial institutions. I suspect no central bank or most central banks, and most of us wouldn't want central banks to be in the position of allocating credit in an economy. Again, there are technological as well as conceptual solutions that these experiments are giving us to mitigate these problems, but they cannot entirely be completely eliminated. And from a regulatory perspective, the key question is how one can come up with new regulatory frameworks that facilitate some of these innovation, but can also maintain financial stability and control systemic risks. But we are moving to a digital world, and while all of this has many benefits, I think one of the key concerns that we should all have at a societal level is whether we're going to lose whatever vestiges of privacy and confidentiality in our financial lives we might have. One might well end up with Bitcoin having this very paradoxical legacy that it was supposed to get us away from government control and the control of big corporations, but instead we might move to a world, a somewhat dystopian world, where governments and big corporations like Amazon and stablecoin become even more intrusive into our economic and personal lives, and that is a worrying concern. And finally, I think if we rely on technology to solve the problems that many of our societies now face, especially the huge inequities that have been exposed to an even greater extent by the COVID pandemic, I think that hope may not be borne out. It's entirely possible that we might move to a much better world, but it's equally possible that these benefits might not be well distributed, because after all, in many economies, especially developing ones, but even in advanced ones, financial literacy, digital access are all unevenly distributed. So many of these new technologies might end up exacerbating rather than mitigating some of these inequities that we see in our economy. So let me conclude with just the title of the last chapter of my book, which I think sums it up in my view. A Glorious Future Beckons, Perhaps. Thank you.
Thank you so much, Eswar. It was extremely fascinating, and you covered all the issues. So in parallel to your talk, there was a few comments rather than questions on the many issues you raised, and I will just briefly summarize some of them. When it comes to the energy use of Bitcoin, one comment is that it is because the people who created Bitcoins did not anticipate the greed of the miners and did not limit the possibility to mine Bitcoins, but maybe a new currency or an updated version of Bitcoins might put this problem aside.
Maintenant, comment il s'appelle?
S'il vous plaît, est-ce que vous pouvez éteindre votre micro? Merci. You raised the issue, but it was also commented that the economies of scale in the issuance of new form of currencies, mostly from the companies that are already very big, might wipe out all the other initiatives, and maybe also the power of the central banks themselves. Talking about central banks, there are a few comments and questions about the way CBDC could affect the democratic control of central bank, if any. And also, there are comments that are very doubtful of the involvement of central banks in central bank digital currencies. A few people think that they are just in a wait-and-see posture and wait to see how the things will evolve in this new realm of digital currencies. So
maybe
if you can comment and share your views on these issues.
Thank you, Christophe, and thank you to everybody who's attending this lecture, and also for your very perceptive questions. We'll start with the Bitcoin one and make 2 points there. First, yes, I suspect that the creator or creators of Bitcoin, whoever they are, we don't know that to this day, probably did not anticipate that Bitcoin would catch fire as a speculative financial asset, which is what it has become. I mean, the Bitcoin white paper talks about creating a medium of exchange, not a financial asset. So Bitcoin has become what it was not meant to be. And with that has come incentives for miners to devote massive amounts of computing power to being the first to mine Bitcoin. And this competitive element, of course, is what creates issues. Now, in fact, there is China has not only banned cryptocurrencies, but also cryptocurrency mining because of the financial stability, but also environmental consequences involved. So there are many miners who are trying to set up operations in upstate New York because, you know, there are many abandoned power plants where these computers can be located, a lot of hydroelectric power and geothermal power that can be deployed here. But this points to a couple of fallacies. First, there is a fallacy that many politicians in the US have taken on, that Bitcoin and blockchain are the same thing, and therefore that limiting Bitcoin mining in some way might prevent advances in blockchain technology. The two are quite different. You can have blockchain technology independent of Bitcoin. So it's just the particular consensus mechanism that Bitcoin uses, the proof of work protocol, that is environmentally destructive. There are new consensus protocols that have already come up. One of the most prominent ones being proof of stake, which involves a much more efficient way of validating transactions without expending so much computing power. Each of these new consensus mechanisms has many advantages and some problems of its own, but I think they're going to lead the way to more efficiency. Given that Bitcoin miners already have huge amounts of equipment and vested interest in not changing the consensus protocol, I don't think the consensus protocol for Bitcoin is ever going to change, but the consensus protocol for the second largest cryptocurrency, Ethereum, is going to move to proof of stake any day now. It was supposed to happen in the fall of 2021, and now I'm told it may happen any day. And that will certainly change the functionality of the Ethereum blockchain, which is already being used much more extensively in this decentralized finance movement. The Bitcoin blockchain is not easily amenable to having the traditional form of smart contracts. So we are beginning to see reactions coming up, new cryptocurrencies, new consensus mechanisms that I think get around some of these problems in an efficient way. Now, another question is about whether, let me start with the question about what the appropriate role of governments ought to be. And this is something we really need to think about, not just as an economic or technocratic issue, but even at a societal level. I think having a central bank play an important role in regulation is important, but when central banks, through the creation of digital money, might end up creating exactly the problem they're trying to prevent, which is financial instability, that is an issue. If everybody has access to a central bank digital currency account, maybe when interest rates on commercial bank deposits are very low, we would all start moving our money to central bank accounts because that is certainly seen as safer. In a time when commercial banks are under financial threat, that might pick up even greater force. So you might create financial instability. You might end up with a central bank being in a position of having to allocate credit in the economy. And as I said, no central bank ideally wants that to happen. But it turns out there are ways around this. The Bahamas has given us a very simple solution. Simply put a cap on the amount of money that can be held in a central bank account, which limits the possibility of flight of deposits from the commercial banking system. So long as we design a CBDC with the right objectives in mind, I think some of these risks can be overcome. And as I mentioned, one can even think about a CBDC as basically providing a payment infrastructure at the back end, while front-end payment services are still provided by the private sector. So you don't block private sector innovation as well. One interesting question, which I think was the second set of questions that was posed, is how one can think about the coexistence of mediums of exchange provided by the official sector, usually central banks, and the private sector. And from the point of view of a monetary economist, this is a fascinating time in monetary history. When money was first created many millennia ago, a lot of the money was issued by private merchants. When paper currency first emerged in China in the 7th century, it was basically certificates of deposit provided by private merchants against the backing of commodities or precious metals. In China in the 13th century, Kublai Khan issued the first unbanked paper currency. He basically made it legal tender by announcing that anybody in his domain who did not accept these pieces of paper as currency would be put to death. Central bank these days have more subtle ways of making their money into legal tender. But the problem with unbacked fiat money is that it does create temptations to print more money, and many governments in China and elsewhere did print money recklessly, which led to hyperinflations. And then there was a long period of competition between private and official currencies. The emergence of central banks, which took place over the last couple of 100 years at different times in different countries, decisively settled that competition in favor of official currencies. But now we're coming back to a world in which private currencies and official currencies might compete. I think this as an economist, certainly competition is a good thing, although occasionally it can have certain risks. But I think this competition is going to take a particular form. My view is that while things like Bitcoin might become speculative financial assets, stable coins and other mediums of exchange could get traction because there is a real need. So what we're going to see is competition between private currencies and official currencies, especially in the medium of exchange function. As I mentioned earlier, stable coins don't have independent value that they accrete. They get value by being backed up by stores of fiat currencies. So from the point of view of stores of value, I think fiat currencies are going to remain very important. And here again, there is an interesting irony. As I mentioned, Bitcoin and other cryptocurrency advocates argue that the fact that a central bank can create money at will should mean that it has less value than something that is scarce. As I argue in my book, it is precisely the fact that a central bank can create this asset that can fuel a financial system at a time of great peril, that actually gives it value even in normal times. So the fact that the Fed or the ECB can print large amounts of dollars or euros at a time when the financial system direly needs it is what makes us believe that those are going to have value even in good times. Now, of course, this privilege can be overused and abused in a way that reduces trust in fiat currencies. And it is certainly not a reflection of a financial system or economic system that is working terribly well. But given where we are with our financial system and economic system, I think fiat currencies have a very important role to play and will maintain their primacy, at least as stores of value.
It could be the last word, but I will ask you a last question. You are very well placed to have an opinion on the role that international institutions can play in the coordination of dealing with these new issues raised by the rise of digital currencies, especially when it comes to the design of central bank digital currencies and the protection of the interest of the weakest states that may not be strong enough to deal with these issues with their own resources.
So there are big challenges coming in the context of regulation, in the context of management of monetary and financial stability policies. So Bitcoin knows no borders, and that is true of a lot of other elements of decentralized finance as well. One can think about payment systems provided not just by Alipay and WeChat Pay, but perhaps a stable coin issued by Amazon or Facebook, gaining a lot of traction around the world. So there is going to have to be coordinated regulation across countries. Trying to think about regulating these innovations within a particular country, I think it's going to be difficult to sustain for a while. So institutions like the IMF and the BIS are already doing a great deal of work in thinking about the conceptual and technical design of CBDCs, so that they create less of a risk for domestic financial systems and economies. They're thinking about how to coordinate regulation of cryptocurrencies and stable coins around the world, because again, we need to think about developing common standards in regulating them, and think about analytically how best to undertake this regulation without completely blocking innovation. But as you pointed out, Christophe, there is another set of considerations related to the fact that while the issuers of the major reserve currencies, such as the dollar, the euro, the Japanese yen, even the Chinese renminbi, maybe they have less to fear from these changes. For many other countries around the world, particularly developing economies and even smaller countries, even advanced ones, there are some very big challenges that are coming up, because we're going to see threats to existing fiat currencies of many of these countries. We're going to see much greater conduits for capital flows across borders, which again has many benefits, but also means more capital flow volatility and exchange rate volatility. And I don't think there are many easy answers to these issues, but I think the fact that we live in an interconnected world is going to become even more obvious as these technologies bind us more closely together and create a lot of opportunities, but also a variety of known and unknown risks. So I think the real role for international institutions here is to make sure that these technologies can be harnessed in a way that improves the benefit to risk trade-off, and that these discussions at the societal level, at the economic and technical levels, are all coordinated among countries.
Okay, we promise that we will not go beyond 1 hour, but we did. So sorry for not keeping our promise. It was a wonderful talk, and I would like, on behalf of all the listeners, to thank you very much for all what you enlightened us with. And we will be very happy to welcome you in Paris whenever it is possible for you to come. So thank you again, and have a good day in Washington, D.C.
Thank you, Christophe, Evgeny, and the rest of your colleagues for organizing this. I'm delighted that I had this platform and CEPII to be able to present on my work. And thank you very much to all of you who participated in the lecture. And again, I hope to see you in Paris in person one of these days. Goodbye.
Thank you. Bye-bye.